Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 6th of May. I'm Daniel Lam, your host for the podcast. Over these few days, reports on the re-escalation between the US and Iran tension was grabbing the headlines. It was easy to miss the April ISM manufacturing report, which was flat on the headline but softer on growth and hotter on inflation. So the index held at 52.7, missing estimates. So despite the unchanged headline, the underlying signals pointed towards mild growth deterioration. New orders rose to 54.1 from 53.5, but production moderated and employment contracted further. Now, longer delivery times helped hold up the headline number. This echoes the regional Fed manufacturing surveys, which had already pointed to moderating growth as the energy shock and geopolitical uncertainties weighed upon confidence. Inflation pressures increased, with prices paid jumping to 84.6 and beating estimates. So this mix of prices paid and delivery times components actually indicates we're at the worst level since May 2022. Net, the report sent a stagflationary signal, disappointing on growth and beating on inflation. So it justifies the Fed's recent decision to stand pat rather than cut or hike preemptively. Inflation was already sticky above target before the war in Iran, and inflationary pressures are now spreading globally. A stronger stagflationary impulse adds risk to both sides of the Fed's dual mandate, and the Fed will likely not move in either direction before it has more clarity on whether the shock affects inflation more than employment. So now, how should investors be dealing with this threat of stagflation? Well, TIPS, i.e. Treasury inflation-protected securities, is a reasonable choice. Energy prices goes up faster, higher, and slower in going down, and there would be quote-unquote support for the current expectations of inflation. Gold is also effective in hedging against volatility, but only at a mild level of volatility, i.e. when VIX is 30 or below. We've seen that in times of extreme volatility, i.e. VIX going above 30, because of the need for liquidity, there could be pressure on gold, as we witnessed back in March this year. However, official buying was strong in the first quarter of this year, suggesting that central banks' diversification away from the US dollar gives long-term structural support for gold. That's all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.